Could you define, like, what is a deferred sales trust and how does that
Yeah,
work?
and it's a tax deferral strategy, sort of like a 1031 exchange, if any of your listeners know about that. It's based upon IRC 453, which is just known as a seller carryback or seller financing is maybe what your listeners would know it as.
Sure.
So it's with the deferred sales trust, we call it a manufactured installment sale. We just add an additional trust to the equation to make this work. But essentially, anyone trying to defer taxes on the sale of a business, primary home, commercial real estate, artwork, or collectible, they can use a deferred sales trust as opposed to a 1031 exchange, which is very rigid and is really just for investment properties.
Sure. So what typically, since this is a different strategy than we've talked about in the past, is there any additional benefits, especially regarding additional tax savings there?
Absolutely. I like to call the 1031 exchange the hammer and the deferred sales trust the screwdriver. And each of them have their own role and their own benefits versus the other. With the 1031 exchange, let's start there as a kind of a context and for tax deferral. So you can trade, let's say, a duplex for a fourplex or a fourplex for an 8-unit, as long as it's equal or greater value is really the key here. It doesn't necessarily have to be a number of units. But let's just say you had a $500,000 property and you've owned it for, let's say, 27 and a half years. It's fully depreciated. Say it's an apartment complex. And you were to sell it today, if you don't do a tax deferral strategy, you're going to be hit with somewhere between 30 and 50% of the gain being wiped out by state, federal, Obamacare, and depreciation recapture. So we always start with what is the depreciation and what is the capital gains tax that you're facing. And then from there, maybe a tax deferral strategy would be good. So people do 1031 exchanges to defer the tax so they can earn more wealth. Well, the deferred sales trust is just an installment sale, but the key benefits are that you don't have to go back into real estate at all, but you can. But the key is you don't have to go back within a short period of time. So the 1031 exchange, the intent is to do tax deferral, but the challenge is you have to do it within 180 days, which too often for so many more of my clients in the past meant they had to overpay for properties. You know, they're selling in a high market and 180 days later, they're buying in a higher market. And so we call this the sell high, buy higher strategy, which we don't think is a very good strategy. We think the sell high, buy low is the ideal strategy. We call this optimal timing. So the deferred sales trust solves all of that, and that you don't have to go back in and within 180 days. In fact, you can go back in 5 years from now or tomorrow or whenever you want, all tax deferred. And the next part is this: you can have a new depreciation schedule. So one of the number one reasons to own real estate, Jack, is to have the depreciation offset the income that's coming in. So let's just say for $100 of rent that's coming in, perhaps you can write off $10 of that against the property. Therefore, although you're receiving the $100 in cash flow, $90 is being taxed. So that's one of the key reasons to own investment in real estate. Now, if you own it long enough, your depreciation gets depleted. And as it gets depleted, you have less and less and less of that. And that's why you do 1031 exchanges to try to get more. But again, the depreciation schedule travels. You can only get more if you buy a brand new property. If you only get more if you do an exchange and buy an extra bigger amount to make sure you get the actual more depreciation. So I'll just give an example. So $500,000 sale again, let's say you're fully depreciated. If you do a 1031 exchange on that $500,000 deal and you buy an exact $500,000 deal, you have no depreciation. Okay. Now, if you buy a $1.2 million deal with that $500,000, now you have $700,000 of depreciation, right? Minus the $500,000 that you've already used. Right. So the solution to that is the deferred sales trust. If you buy that same $500,000 deal through the deferred sales trust, you're getting a brand new $500,000 depreciation. And here's why. A 1031 exchange, the depreciation travels. IRC 453, you're not traveling the depreciation. In fact, you're parking the money and then you're partnering, forming a new LLC, which you're going to buy the property, which gives you a brand new depreciation. So I'm going to pause there because you might have some questions there.
You have just listened to another information-packed episode of Capital Gains Tax Solutions with Brett Swarts. We hope you enjoyed today's show and found it helpful. Visit capitalgainstaxsolutions.com to access the show notes and to access more resources. Don't forget to leave a review and join us again next time.